So how is the private credit market holding up these days with so much volatility in public markets, so much uncertainty from a trade perspective?
Well, private credit, if done well, is a defensive asset class, defensive strategy. You're in direct lending, you're top of the capital structure, you're cash pay, you're lending to high quality borrowers. Certainly when we do it, and we've done it for 28 years, we tend to find stable sectors, defensive sectors, market-leading businesses, certainly with pricing power. And so we try to have an all-weather strategy. And so the volatility, the uncertainty that we find in the markets today, I would say, we stay the course. We started back in the 1990s, it's been a good strategy for us, and trying to stick to what we've done for a long time.
And when we talk about private credit, so often people think about direct lending, but the asset class has ballooned to so much more than that. What do you see as the big growth areas now? And kind of talk to us about the evolution of private credit in the last decade.
That's right. It started quite some time ago in direct lending, mid-market, getting more into large cap. Lending both in the US and in Europe. So you got diversification today. But you're right. A lot of the excitement around private credits is the fact that you can really replicate a portfolio that otherwise you would have maybe on the public fixed income side, and you can replicate it on the private side. So it's direct lending, it's asset-backed finance, it's increasingly investment grade, but also it's junior capital. A lot of excitement, certainly on our side, around the opportunities in hybrid capital, in junior capital. And then we're seeing a lot of opportunities also in infrastructure, in energy transition. And so it provides really that wide diversification that is good for a credit portfolio.
What are you thinking right now about Europe in particular? You mentioned an infrastructure investment. There's a huge push to spend more on infrastructure coming out of Germany right now. Many are saying that this is the renaissance moment for Europe. Is that how you feel? Is that what you're seeing in terms of deal opportunity?
Well, we started back in 1996, and on day one, we were global. Right, US, but also outside of the US. And actually, if you look at our platform today, it's about half of our assets are in the US, and the rest is outside. So Europe has always been very important to us. We've always found good opportunities, really high quality businesses that we've been lending for a long time, by the way. Our first investment back in the 90s was in a European company that we stayed invested in for about 2 decades, even after that company IPO'd. So Europe has been a good environment for us, a good market. We're very large here in terms of our portfolio. We have over 150 portfolio companies in Europe, and these companies need capital. They're growing, they're making acquisitions, they tend to be also more global, larger in size. And so we like it here. We like Europe. Also, the barriers to entry and the barriers to compete in Europe, we find are a bit higher than maybe anywhere else. You're getting paid for complexity. You need to have offices all over. You need real presence, local presence. You don't do a deal in the same way, in Northern Europe, Southern Europe. And so you've got all these kind of complexities that certainly are helpful for us to price.
It feels like that's changing a little bit now as more people recognize the opportunity in Europe relative to the US. Are you seeing competition increase here?
Yeah, again, the question around, capital, too few opportunities. But the key question is, does that capital get access to the deals? Origination is a scarce commodity here. And so a lot of the capital is not getting access to the deals. We're very fortunate to be part of that broader ecosystem at Goldman Sachs, having done it now for almost 30 years and working hand in glove with our investment banking colleagues all over, by the way, not just in Europe. And that really means that we're at the inception of an idea when somebody wants to buy an asset, when a board is thinking about maybe selling a division of their business, or you're talking about infrastructure, right? And so origination is the key here. And a lot of capital is not really getting access to the origination. We're certainly seeing great activity level, even if M&A is muted. So far this year, we're seeing great activity level.
Do you think that's going to change anytime soon, the M&A picture?
Will it rebound? I don't know. But certainly, without the M&A rebounding so far this year, we're seeing record deployment. But I would say our business, it's not about deployment, it's about underwriting, right? It's about sound underwriting, cautious underwriting, it's about investing. Because the only alpha in credit is to avoid default and losses, right? So not so much deployment, but stay in the course, not having that fear of missing out, and trying to do what we have done for a long time, and that has been successful certainly for us.
There is some concern now that there is too much capital chasing too few good opportunities. You talk about default being the big risk when it comes to private credit. Are you worried, and should we be worried about too much capital chasing too few opportunities and what that could mean for the quality of the companies that you invest in?
We're not worried per se, but what we think is that you're going to see dispersion of returns, dispersion of performance. I think it's already happening. Not all private credit portfolios are created equal. It's back to the fact that you need a proper origination engine, teams that are experienced, that have done it for a long time, and you need to be there at the inception. When the idea emanates from a board or a private equity firm wanting to buy or sell an asset, you need to be there for them, right? To be the first call and basically craft that deal with them. And not everybody has that ability to originate. And the more you see, the more selective you can be at the end, right? I mean, it's back to what I said. The alpha is just avoiding those losses. So I think you're going to see dispersion of performance. That's very clear. You're going to see winners and losers, and that's the sign of an asset class which is maturing.
And who's going to be the winners here? The bigger the platform, the more successful to date. And there is sort of a running away from the pack that we've seen from the 3, 4, 5 heavyweights in this space. Is that the dispersion that you are talking about?
I think the larger platforms certainly have more resources to originate, more resources to underwrite. And then when you have issues maybe in the portfolio, they have more resources, certainly we do, also to work these issues in the portfolios. What you're seeing, by the way, is that the fundraising is starting to get consolidated as well. And certainly in Europe, there are stats showing that fundraising, like the top 10 platforms, are starting to get most of the fundraising, but also most of the deal-making activities. So I think it's inevitable, whether it's organic or through M&A, you're going to see more consolidation across those markets. And again, it's just an asset class which is maturing. We've seen that in other asset classes, and it's happening now in private credit.
And what do you think about the risk of the interconnectedness of banks with private credit? Regulators around the world are sounding the alarm that they don't like the fact that banks are lending to private credit funds, given the opacity of the industry and how many layers of risk there are.
Well, for us, being part of Goldman Sachs is certainly a huge advantage. Whether it's origination, whether it's information, working hand in glove with bankers, but beyond bankers, getting that access, and also trying to provide more than capital to the companies that we lend to, right? Providing them access, providing them information, advice, and so certainly, as far as we are concerned, it's been an edge since we started back in 1996, and we work very well with all the banks. By the way, they're very good partners of our platform as well.